This is the end of the year Chartapalooza with Josh Brown, presented by YCharts. Thanks everyone for joining. I do have just a couple housekeeping items to rattle off before we get into the good stuff, but two very important questions for Caleb and Josh. So last year we did this. It was an awesome time, but there was this whole pizza showdown with taste testing and New York versus Chicago. This time there's none of that. So is this a recession indicator that people should be following?
Was that last year?
That was last year, if you can believe it.
Okay.
I think we got too many complaints about people that didn't want to watch me eat pizza again. So
I was like leaning away from the camera and trying to take bites off screen. And then I would like come back on screen and there would just be like sauce. And it was a great idea, but I'm glad we're not repeating it.
Yeah. Okay.
Great to do. It was great to do once.
Great to do once.
Does the Q&A function, is that working?
It should be. If anyone in the audience, this Q&A is going to be working. So when you have a question, I see Akbar just chimed in. Hello.
There we go.
Hello, everyone who's joining.
All right.
We can see your questions. Go ahead, Josh.
So we want people to be super engaged. We want people to be super engaged in the chat and ask questions or make funny comments and try to make us laugh, obviously on topic. And whoever says the funniest thing in the chat or the most interesting thing or ask the best question, Tanya's going to let us know who that is. And we're going to send the gift out. So we're going to send you guys something from the idon'tshop.com official compound store. So light it up and be witty.
All right. The gauntlet has been set, everyone. So definitely now there's something on the line. But quick couple housekeeping items. So as Josh was just saying, all your questions, comments, thoughts can be submitted via that Q&A at the bottom of your screen, and we're following it. We'll definitely take those questions as they come up. Also want to let you know that the charts discussed today are going to be uploaded as pre-built templates to YCharts. So if you're a user, you'll be able to jump in and use those. If you're not, sign up for a free trial, head to our charting tool, and you'll have all these visuals that we talk through that you can play around with, make your own, share on to whoever is in your circle. And finally, a recording will be sent to all attendees. It'll probably hit your email later this afternoon. It's also going to be uploaded on our YouTube channel. So head over to YCharts on YouTube and hit the subscribe button. Also, of course, head over to the compound, subscribe there as well. And without further ado, let's get into some charts. Thank you, Caleb.
Yeah, do you want to kick us off with a little rundown of what we're going to be talking about, and then we'll see how much we stay close to this agenda.
Yeah. Let's see how well we stay on topic. But so this is, broad strokes what we're kind of seeing over the last year. Inflation hitting the markets in a big way, and then the Fed responded in a big way, or to be debated, I guess. And that caused stocks and bonds to spiral and then finally, we're going to talk about that second half rebound. Got some cool visuals to talk about that. And then what might be in store for 2023, trends, names, interesting data that might be worth following. All right, now we're going to jump into YCharts. And Caleb is going to start us off with the most exciting topic of the year, which is inflation, CPI.
Yeah.
Is it exciting though? Are we excited?
I think we're excited that maybe the trend is changing. What do you think, Josh?
All right. I'll take that.
So we're going to do things a little different this year. I've just got YCharts up live here. I've got some charts pre-built, so we can edit these charts. We can add things. However the conversation goes, we can work on them. But right now we've just got kind of how prices in total have changed. So the purple line just shows prices are up a little over 14% since 2021. And then you can see that orange line is kind of the year over year inflation print everybody's been talking about, peaking out at a little over 9%, right now sitting at close to 8%. But yeah, I mean, is this, Josh, where are we headed here? I mean, it's definitely the thing we've been talking about most.
Well, we got another sort of disappointing PPI this morning. Next week, though, is really action-packed. You have Tuesday is CPI, Wednesday is the FOMC decision, and then Thursday is retail sales. Like that is really, I think that middle section of next week really determines not only how we end the year, but like how January goes. And I almost never say that, but I just feel like we could get a really rough 6 weeks if we don't see more evidence of softening in the Tuesday and Thursday number. I think the rhetoric from the Fed is going to calm down. I think now it's more about terminal rate and length of time at that terminal rate, as opposed to like how like the size of the increases. Like I kind of think that part's over. The thing is, though, what makes that hilarious is the Fed's own forecasts are so horrible historically that it's almost pointless to pay attention to, even though the market absolutely will. Like we will have huge overreactions, good and bad, in the stock market, despite how little the Fed has been able to predict how long it would stay tight in the past. Just a fun fact, as recently as September 2021, which is 14 months ago, the Fed thought they were going to do one rate hike in 2022. And instead, we've had the fastest tightening cycle ever. So just like whatever. So when I say like next year is going to be important, next week's going to be important, just like bear in mind, things change really fast, number one. Number two, the great Hollywood screenwriter, I think William Goldman, said, nobody knows nothing. Nobody really knows anything, including the Fed. Just look at the last 5 years of their forecasts and you'll fall out of your chair laughing. And then the third thing is, like, stocks are really resilient. If I would have told you on January 1st of 2022, we were going to have 500 basis points in rate hikes, you would have been like, oh my God. And then if I would have said inflation is going to have an 8 handle, you would have said, oh my God. And then if I would have said, and the Dow Jones Industrial Average is going to be down 7%, you would have said, no way. But here we are. So even if you know what the news is going to be, you still don't understand the resilience or lack thereof of the stock market, and you still don't have a full enough picture to understand how prices are actually going to react to this data as it comes. I don't want to eat up the whole hour on this, but I feel like
how resilient
this is important. This is important.
Yeah, you talked about how resilient the stock market is to these changes. What about the consumer and people's actions? Are you seeing that same resiliency? Do you expect that same resiliency if this trend continues?
You know, it's interesting. It's like this moving storm cloud that hovers over one sector of the economy at a time, and the rest of the economy is in the sunshine. Like that's like the best analogy I can come up with right now, where like housing is so awful. If you want to enjoy yourself reading a conference call transcript, go look at what the CEO of Restoration Hardware, I know it's called RH now, go look at what the CEO of RH said yesterday about the luxury home market. And this guy's great. He like just pulls no punches. He's like, it's 2008. Like that's what he's saying. While that's taking place, you cannot get a seat on a plane. Like hotels are full. In Manhattan, try to go out to dinner on a Thursday night to like one of the top 100 hottest restaurants. You cannot get in. So these two things seem incongruous. They shouldn't be occurring simultaneously, which is one of the things that's making it so hard to make economic forecasts in this environment. And the answer to the riddle of how is because I don't think the economy, it's a 70% consumer-driven economy, and it doesn't all have to be good or bad at once. We have to stop thinking about the United States consumer monolithically, or it's great, or it's terrible. No, they stopped spending on furniture. We did that already. If you bought a dishwasher in 2021, and you definitely did, are you going to also buy one in 2022? So like from that perspective, it makes sense that there's this asynchronicity in different areas of the, it's not all one economy. We've had regional recessions. There was a recession in Texas in 2015, 2016. The price of oil and natural gas crashed. If you were living there, it felt recessionary. We didn't give a shit in New York. So is that a recession? Technically, yeah, just it's specific to an industry. So I think that's what's going on, and people are having a lot of trouble with this. And we're reaching for terms like vibe session and earnings recession, and just call it what it is. It's a very complex economy with different parts moving in different directions at all times.
Yeah. On that point, maybe Caleb, let's look at some housing data, some mortgage rates, because that, I'm a renter, not a homeowner. And I think that's, homes and those kind of assets are so tied into wealth, but a lot of people in America don't necessarily own a home. So that's kind of one of these bifurcating the groups like you're talking about, Josh.
This is the worst part of the economy right now. And it was the best in 2020 and in 2021, but we've had our fill. It's not normal for Case-Shiller to be up 44% in a 2-year period of time. That's not normal. That doesn't make any sense. And actually, one of the craziest things about this year, I don't even think most people are aware of this. The Fed was stimulating the housing market until March, full speed ahead. I think they just stopped buying mortgage bonds in September. Please listen to me. The Federal Reserve was buying billions and billions and billions of dollars worth of mortgage bonds after the average home price went up by 50%. What are you doing? Show me the textbook from previous economic periods of time where it made sense to continue to inflate a housing bubble. So they did that. And I'm sure they had like their internal rationale that they're like support. You can't even make one up, but that was a real thing that happened. And they know it was a policy error. They know it was a mistake, which is why they're trying to undo it so quickly. So the mortgage / home price part of the economy, which is very big and very important, by the way, there's a multiplier effect on new homes. There's a multiplier effect on all this construction and renovation. It's an important chunk of the economy. I've heard people say it's as high as 18% of the economy. If you factor in all of the shock waves from it. But this is not going to be good next year either. The saving grace for home prices is the scarcity. I think we have a 6-month inventory of homes on the market, which is still pretty low historically. We're underhoused, and that's what's keeping things from really falling off a cliff. But go talk to a mortgage broker. These guys are suicidal. They may never see a refi, paperwork for a refi for 2 years. Like they don't, their business effectively completely shut down. We talked about restoration. Anyone doing any kind of high-end anything with homes, they're on ice. And the construction is not going to rise to meet that scarcity because you can't get labor, can't get lumber, we're still dealing with labor supply shocks, material supply shocks. That's not like actually over. And so you're not going to see KB Homes and Toll Brothers like go racing into this breach to build all these homes that we need. It's the pace of home building historically has been glacial. Even in housing bubbles, it doesn't tick up much higher than where it already is today. So
how are you thinking about how housing prices at this point, are housing prices fully baked in to the CPI prints? I know there's the whole lag time with owner's equivalent rent and everything we've heard about how there's still time that it took for that to actually impact CPI. Will decreases in housing prices be the biggest thing to drive that number down? How linked?
Well, I think we hit a new record last month in multifamily, a record that goes back to the mid 70s. So multifamily actually is an area where the supply is coming online rapidly. Very different from single family homes. So I think that's going to, in part, alleviate that situation. I also think some of the hottest markets for real estate that are skewing up the numbers are some of the markets that are most susceptible to job losses. A really great example of that is Northern California, the Bay Area. All the startups laying people off in Brooklyn. Like, these are the markets that are the most ridiculously priced. All this crypto nonsense blowing up in Miami. So you're going to see some of these markets that were just like you couldn't rent. But it's such a huge lag. And one of the big stories in the New York papers yesterday was that the average rent hit $5,200 a month. Think about how insane that is. And that's the average. That means half the apartments are renting for more. And so we live in the most insane of all of the insane cities. And again, we want these things to be rectified quickly, but it just doesn't work that way. I think we're knocking out the demand side, at least for home buying. Eventually that will catch up to rents, but it doesn't stop on a dime. And by the way, it didn't start on a dime either. So
Yeah,
It's true.
Caleb, I think, Josh mentioned labor, mentioned unemployment a little bit. I know we had some jobs data to look at here, and this is a pretty,
this is a good chart.
pretty crazy trend.
What are we looking at here?
Yeah, so here we've got job openings in the purple line here, in the blue line, or no, the purple line's job openings here peaking back in March, still starting to trail off. We've got the unemployment rate, the blue line here, down at 3.7%. Unemployed people that are seeking jobs. And then down here, we've got the spread, right? So this is the number of jobs basically that are available in excess of people seeking jobs.
So we had Bryn Talkington, a friend of mine, on the podcast this week, and we taped it the other day in Houston. And she was saying, like, no matter what you say or do with interest rates, we are 3.5 million under where we need to be for the labor market. Like, there's a 3.5 million person shortage right now. Don't pay attention to that open jobs number. We could talk about that if you want. That's a fake number. Just pay attention to where we are now, the labor force versus pre-COVID. And it's not like they're waiting for their moment, like, oh, now I'm going to work. That's it. They're done. They're retired. They're not coming back. And the other thing we did, and this is not political, but Trump shut down not just illegal immigration, but legal immigration. We were significantly below the amount of legal immigrants, and we kind of can't afford to do that anymore. And then when COVID happened, there was no immigration whatsoever. Legal, illegal, just none, zero. And we have a lot of industries that they require immigration. Like the hospitality industry, there's no robots that will make a bed or clean a bathroom. It doesn't exist yet. So we are not doing ourselves any favors, which is why there's a bipartisan immigration reform bill making its way through Congress. I'm not saying it's a slam dunk, but it's got a 50-50 shot of passing. And part of that is because even if you're in a red state and all your constituents are wearing the stupid red hat, there's still like this reality on the ground that like we need people to come do these jobs. So between retired people that have just walked away from working during the pandemic to the lack of immigrants, this is something that could be with us for a while.
Good stuff. Moving right along here, we've talked about the Fed a lot. We're going to start looking at some of this, the Fed funds rate, Fed balance sheet a little more. So Caleb's pulling up these charts, and we got a question a second ago from Matthew. Josh, what's your prediction for next week, 25 or 50 bips?
It's 50, but I don't really do predictions, and I wouldn't like that's not our investment philosophy. And I wouldn't make a bet on my own gut instinct with this kind of thing. If they did 75 basis points, I think most people would talk themselves into saying, yeah, that's what I thought they would do. And I would be one of them. So I'm saying 50, but if they did 75, I'd be like, yeah, 75 is right. So don't rely on me or anyone else making interest rate bets.
Gosh, maybe better than a prediction. Like, where do you think they should be going? Like if you could influence the Fed.
They have 500 PhDs running around. What do I think they should do? I don't. I think that if you read my blog posts from the summer of 2021, I was screaming for them to stop buying treasuries and mortgage bonds. Like, there's 20 posts screaming. And I wasn't saying like I'm smarter than the Fed. I was just like, listen, man, I'm 45-year-old father of 2. I own a business. I employ 50 people. I have 2 kids in school. I have car leases. I'm like in the economy. Like, I'm hardcore in the middle of the economy. I'm doing all the things. I'm booking travel. I'm pushing a cart around Whole Foods. I'm in the middle of it all. I'm not a PhD. I'm not sitting in Washington, D.C. in a think tank. I'm like a real guy. And I'm saying what you guys are doing is insane. And I was like combining like the what I'm hearing from people in the economy combined with what I'm seeing in the stock and bond markets. And I'm just like, it's SPACs and it's crypto and it's like an IPO every 10 minutes. And it's just like so obvious to me. This is not a time to be stimulating. And I don't even understand and that's in March, we had the Biden stimulus package, which was also insanity. And even that, like the Fed should have looked at that and said, well, if they're doing that, we could chill out. We could maybe start talking about tapering to offset Biden dropping another 1.3 trillion or whatever it was on the economy, which was also completely unnecessary. Right? I think the Fed got a little bit political sometime in 18 or 19. I forget which Jackson Hole speech it was, but it was something to the effect of the institution now recognizes that by tightening rates too quickly during a recovery, they are denying jobs to people at the lower end of the income scale who would have gotten hired later in an upcycle. And I think there's a racial component to that, where they're looking at like how people from different ethnicities or race groups are affected by interest rate tightening. And like the Fed kind of played into that whole, politicization, identity politics stuff. And I think that's part of the reason why they stayed as easy for as long as they did, why they ignored the early signs of inflation, because they think like institutionally, they're trying to do the right thing for all Americans. And it's a noble pursuit. Personally, I don't think the Fed funds rate can fix racism. I mean, I know that's a crazy statement to make in this day and age, but like I respect that they're trying to not just be an institution that's serving banks and bankers, but they waited way too long, and I was like yelling about that. I don't think that I'm like an expert or I know better than them. I just thought at that time it was common sense for them to pull back the reins. So what would I tell them now? We're not going to listen. I think let the first 3 or 4 rate hikes you did in the spring work their way through the economy. Like give it time. Don't worry if the next reading is hot and everyone's going to be tweeting. Like we know that these things operate on a huge lag. We know like in the housing market historically that rate hikes and rate cuts take like 18 months for the effect to be felt historically. When they're doing 25 basis points. So these are gigantic rate hikes, and they were felt in the mortgage market immediately. So I guess I would just say, like, can we just see what happens with the last 3 75 basis point rate hikes before we throw another one on the fire? That's, plain and simple.
Yeah. Had a interesting question from Connor O'Brien. I think it might be our friend from OShares, but he asked, kind of on this point, is it is it about the Fed rate hikes, or is it just about waiting for people to run out of COVID cash, as he put it, their excess cash that they've saved over the last couple of years?
Well, so here's the problem. This has been Bank of America has great research on this, and it's Merrill Lynch quants going through Bank of America deposit information, and they estimate the number of excess savings above what it would have normally been pre-COVID is like $1.5 trillion. Like that takes a really long time. Or 1.2, excuse me. It's a huge number. The Fed did like 9 trillion in stimulus, and the federal government did like 5 fiscal. So we had like $14 trillion in stimulus in 18 months. So there, like it's going to take a really long. It could take a year or 2 years, they estimate, to work off that level of excess money. And it's not just working off the money. It's like the thing that keeps the labor market abnormally strong in the face of these. It's the thing that gives consumers the bargaining power, not consumers, potential workers, a bargaining power, and it keeps services inflation elevated. It's like it's causing. It's at the root. This overall level of the. It's at the root of a lot of what the Fed is trying to work against. They can't. It's politically unpopular for them to be like, we need everybody's personal situation to be a little bit shittier to accomplish our goals. But like, that's literally what they need. I did a blog post about this called "You Weren't Supposed to See That," and the premise of the post is, we did this huge involuntary experiment during COVID. What if everyone was just good? Like, what if we gave every single person enough money to pay their bills and like their rent wasn't due and everyone was just like good at the same time? What would happen? Now we know. 8.5% inflation, and the economy is like breaking in half from the strain of trying to meet all the demand. There are lines outside of the Gucci store. Like we know now what that does. So the inference that I took from that, which is a little bit dark, but whatever, we'll go there. The only way the American dream actually works is if most people are still striving for it and haven't gotten there. If you give everybody like, all right, you're all good now, the American dream fails because businesses can't hire people to operate. And like all of these things just can't get done. And we have financial bubbles and we have scams and frauds that are now blowing up. Like, we actually need people to be struggling for some people to attain the American dream. That's not popular. Like, what politician would ever get up and be like, we're going to screw things up for 40% of you. The other 20% will be fine. And then like the top 40% are going to be like really good. It almost like, even saying that out loud sounds anti-American, but it's actually the reality of the American dream, which is why we need immigration. And it's why teenagers have to have, bad, low paying jobs. Like, the only way this works is if there are people that aren't good yet. And that's the experiment that we're now unwinding. And it's not finished yet, as you can see from this chart.
We're all just rats in a maze. All right, moving on. We want to talk about the market, stocks and bonds, Caleb?
Yeah, let's do it. It's been an interesting year. Well, let me start with this chart. Let me find it real quick. So I think we had 5 different, or I guess 6 different movements in the market, kind of one direction or the other, of greater than 10% since the beginning of the year.
I want to preempt this. We got a question from Rob Black. How many times has Josh changed his hairstyle this year? And can we track it like the Greenspan briefcase indicator? If so, can we get a chart as well? I don't know how you would chart my hair. What's been going on is I'm in a transition phase. I had like very short hair last year, and I had this like realization. You're like, it's like, dude, you're on the way. You're not bald. You're like very close. You're on the way. So like, this is your last hurrah to have enough hair to actually comb. So like, why would you be in a rush to get there by having a buzz cut? Like, eventually that's going to be the only hairstyle you could have, I said to myself in the mirror. So it's not different hairstyles this year. It's just been growing, and it's still terrible. All right. What are we doing here? S&P total return?
Yeah, I mean, maybe this is also representative of kind of where your hair's been going, but
Yeah, no, definitely. Right direction.
we're getting bounces here and there of greatness, but no, these are moves of more than 10% in the S&P 500 this year. So, big move down followed by a bounce, big move down followed by a nice uptick.
This is called the downtrend for those who are new to investing. I mean, could it be more textbook? Lower lows, lower highs. We have a tactical model that we manage in-house. It's not our client's whole portfolio, but it's a portion, and we try to only use it in non-taxable accounts because we're not looking to generate, outrageous gains and add to their tax bill. But if we can run this in an IRA, we will. But we call it goaltender, and goaltender is index ETFs. We cut them into slices, and they react to a downtrend based on different time frames. So we'll run SPY, triple Q, the most liquid. We've had mid caps in there, but the idea is not to, sell the top and buy the bottom. Nobody can really do that. But what you can do is you can say, this particular slice of my tactical model will go to a sell signal on a breach of the 6-month moving average or the 8-month or the 10-month. So we're trying to effectively, when it's statistically clear that we're in a downtrend, not like my opinion or how a chart looks, but the actual stats that we are in a downtrend, we're shedding exposure. And this is a strategy that by definition is backward looking. So you're not going to buy in at the bottom. You won't start adding back exposure until that trend starts to become an uptrend. You're going to be late, but that's not the point. The point is you can sit out for 6 months, which we did, while the market just chops itself to pieces. And so there has not been a buy signal in any of the timeframes we follow until the end of November. And so we started shedding index exposure, the NASDAQ, at the end of February. By the end of April, nothing was along S&P, Qs. And so just like the ability to sit in short-term bonds and not have a view or an opinion, but just not have money at risk while the market churned itself to lower lows and then rallied and then a lower high and then rolled back over. And we never got the buy signal until the end of November. So this is a year that tactical helped. Some years it's a drag. Some years it churns you up because there is no trend. This one was as obvious as of a downtrend as you get.
Volatile downtrend, though. I have to imagine there were some people.
Three separate bear market rallies, including this one. Yeah. March was 11%. August was 17%. I'm doing this off the top of my head. And I think this one that we're in now is 11 or 12.
Interesting thing, though, is the correlation with bonds, right? You mentioned short-term bonds being kind of a safe place to park, but I think people that have had the longer-term bond exposure in their portfolio throughout the whole year, we've been hearing a lot just about the 60-40 portfolio and how that's been down almost as much as just holding the S&P 500 or holding the stock market.
Oh my God, the bond market was brutal. Most financial advisors have some version of a 60-40 or a 70-30, and the bonds are supposed to offset the drawdown in stocks and serve as dry powder. And this year they didn't. It was the worst start for a 10-year U.S. Treasury since 1788 is an actual stat that I read somewhere. And this was before they were called U.S. Treasuries. But it was really the worst start for a year. It was one of the top 4 worst years for a 60-40 of all time. Like every superlative that you can come up with, negative superlative for the way a 60-40 portfolio worked in the first 6 months would be applicable. You really could not find much worse out there. You had to comb through eight decades, and maybe there was one year in the 30s or two in the 70s, two in the 30s, but like it was really as bad as it gets. So what's a takeaway from that? Well, if you are in the financial media, then you're writing articles now about the death of the 60-40 because you are a moron. The reality is everything about the 60-40 just became more attractive. The PE ratio on the S&P 500 has gone from 23 to 17, probably on its way to 15. That's backward. Forward, it's maybe even a little bit better. So the valuation for the 60 part is so much better than it was last year. And the 40 part, forget about it. We were putting bonds into clients' accounts and like, well, what is this for? This is yielding half a %. It's for the stability. Now I could buy you a 1-year treasury at 5%. Like the 40 part has a lot of meaning beyond stability, and you can take less duration risk, no credit risk whatsoever, and earn yields that you would have begged for a year ago. So if you are sitting around scribbling out an article about the death of the 60-40 now at the end of 2022, I'm embarrassed for you, and I hope nobody reads it, because we've done a lot of work this year and gone through a lot of pain to get to a much healthier starting point for that type of portfolio allocation.
So stronger yields, better valuation in the markets. Is this correlation though between bonds and stocks going to break down? I mean, historically,
it always does. Eventually, it always does. You know why? Because pensions and insurance companies have to buy something. So one of these will break. None of them can sit in cash. And you're talking about like $40 trillion just between those two. So do they have to break while the Fed is shrinking its balance sheet by $1 trillion a year? Maybe not. Like I would argue Fed funds rate might be overrated in terms of its effect on the stock market, and QT might be underrated. So for as long as we're doing QT, you might be locked in that kind of like correlation death match. But it can't last forever because people have to invest in something and they will choose, and one of these will win.
You mentioned investing and buying. We kind of looked at some scenarios, and I'll try to pull these up as you're answering the question, but who has this period been hardest on, right? So I think anybody that's been consistently investing throughout the year, like that money they've invested this year is remained pretty stable. But people that came in to the year with a big portfolio, or people that have been drawing income on their portfolio this year, are probably feeling the pain more. How are you thinking about the different, I guess, where you're at in your life cycle and how this market's affecting your ability to reach those goals?
So I think there was like this widespread mental illness amongst people who were like 16 years old, young men who were like between 16 years old and 35 years old, where in the last couple of years, they like discovered the markets and they followed a lot of people who were unqualified to be followed. And they did a lot of things that were inadvisable. And some of those things in the early going were like working. So they kept going, or they used margin, or they graduated from buying a stock to buying a stock on margin to buying options. Like all of that stuff had to get wiped away. Like it had to. It was very unhealthy. It was this like young male toxic energy of like, I don't need to learn anything. I don't need to listen to you. I don't need a job. Like I just wake up and trade shit on my phone, and I'm moving a Brickle, and my dad's an idiot who worked at a desk for 50 years, and I'm on TikTok getting paid by brands to like whatever. Like it had to go. And that was like your nephew or your younger cousin at Thanksgiving, and it was just insufferable, and it had to die. But it hasn't been replaced by anything. There's like a vacuum now of like, what are these people doing? We know they're not trading. Look at Robinhood, common stock. Look at Coinbase. We know they're not trading. That's the one thing we know for sure. We don't know how many of them started reading books, God forbid, and like actually learning about investing, and actually like came to the epiphany that, oh, you mean people have done this before? Right? So, but every generation comes into the market and starts that way. This just is the first generation that had social media. You get me? Like Twitter is started in 06 or 07. It didn't exist when the Gen Xers discovered investing. There was like Yahoo message boards. So this was like my generation discovering investing, but on steroids, because we had to see and hear all the bullshit on all these platforms. So it's fine though. This is like nobody comes into this smart, and you have to lose money to learn how to not lose money. Like it's a progression. So we don't know like what's going to take its place. I don't think that somebody's going to go from crypto to 60-40 indexing. There's probably going to be a step in between. And maybe that's like the value stock rally now. Maybe that's like people realizing like, oh, you mean you could buy an oil stock and they don't make semiconductors, and it actually, the stock can go up. So maybe that's like something that's going on. I don't know. I think like, I think on balance, it's good that we have 25 million new people become investors in the last few years. And it's good that they got wiped out like within a year. That's like 4 years worth of college, and you still wouldn't learn what this generation of investors have learned in like 12 months. So I don't root for anyone to lose money. And I have, believe me, I got plenty of stocks that went down also. So don't worry, like everyone else. So it's not a smart versus dumb thing. It's just like, you have to do this for a while to understand how it works and what the stakes are. So I don't know where the puck goes next, but we'll see if we get a wizened class of investors out of this. I hope so.
So Josh, I'm going to change topics here a little bit as you're talking about, individual stocks, what's been happening with some companies that saw huge run-ups. I think it is interesting just to look at what's been moving the index this year. Looking at the S&P 500 this year, you see, Amazon, Microsoft, Apple, Facebook, Tesla, Google, NVIDIA, these names that, I think we even talked about this in our conversation last year, like, hey, everybody owns these stocks. Everybody wants to own more of these stocks. These are the stocks that kind of killed you this year. How are you thinking about those names?
I'm in Alphabet. I'm in NVIDIA. I'm in Apple. I'm in Amazon. It's okay. It's like, it's okay to be in them. The question is like, what are your expectations? Like, are you like so overweight these names that they have to work or else your portfolio is dead? Like, that's not great. So like, you can be in NVIDIA and also Berkshire Hathaway B shares. And like that's always been I always talk about diversification. It's more than just like a buzzword. It's meaningful. And then when you have a portfolio and you're like, why aren't all my stocks on the 52-week high list? Like, that's not great if they are, because that means you own a lot of the same trade, whether you realize it or not. And very quickly, you can have an entire portfolio that's on the 52-week low list. So you never want to be in a place where you have synchronized market-beating returns in your whole portfolio. I know it sounds great, but this is a marathon. So unless you're playing for a 30-day outcome, if you find yourself in a situation where everything is green, you probably are taking a lot of concentrated risk. It's just reality. So this year, industrials look great. Defense stocks are making record highs. Energy, a lot of areas of materials. And what looks terrible? Consumer discretionary, tech, and anything home related. And then there's a whole lot of stuff in the middle. Biotech, somewhere in the middle. Not terrible this year, right? But that's what it should look like. So when you get it like the first half of 2021 was the aberration. 85% of S&P 500 companies should not be above their 50-day moving average. That's the thing that's weird. Not this. This is what markets do. They humble you. They let you win a little while you lose a little. Like that's how returns are formed. It's the offsetting of the gains and the losses. It's all gains. That's not how it works. So I don't think that this year is particularly out. Oh, one of the other things, Bryn is so smart. One of the other things she pointed out, she's like, actually, if you said this is late cycle because the Fed is starting to hike earlier this year, and you just followed the classic late cycle playbook in the stock market, it worked perfectly. It worked perfectly. You rode the financials in the first half of the year as rates rose, and then energy took the reins, and industrials. That's all late cycle stuff. That's what should have happened. I thought she made a really powerful point. Staples, classic late cycle. Where are the staples on here this year? Consumer defensive. Right. That's what it should look like.
Yeah.
Yeah,
This is
that's a great point. Sorry, go ahead.
Go ahead, Caleb.
I was just going to say, we're looking at, the frustration and the correlation between bonds and stocks, but everybody wants their stocks to be correlated and moving up at the same time. It's a little bit of.
They should, right. They should. My answer to that is always they shouldn't. Now, when I was a retail broker, it was really hard. You'd buy like 10 stocks in a client's account, and there would always be one that was down a lot. And that's the one the client wanted to fixate on. And they could be up like 17% net on the year. If they had one stock that was down 20, offsetting 9 winners, like that would be the whole conversation. Why did you buy that? Why shouldn't we sell it? On and on and on. That's just human nature. We should not fixate on what didn't work this year, because oftentimes what doesn't work in one year, what you're doing is you're planting the seeds for it working a lot, at some point in the future. It's just, you don't know the timetable. Like oil underperformed for 7 years and then went up 65% this year. You had to live through like a lot of pain, not just down in relative terms, relative to the market, but down in absolute terms, like negative years. Yeah. Oil went from being, I think, 9% of the S&P to 1%. And you had to, if you wanted the 65% this year, all of it, you had to live through that because you didn't know when it was going to happen. So people just have to get accustomed to this non-correlated green and red in a portfolio, and you have to not be a child about it.
Yeah, if you had the discipline to hold on to it, though, you were happy.
Hey, I want to answer this. I want to answer this question from David. I know we're running out of time. David Diller asked, put call ratio peaked at. Can you guys have that? Can you do that? Put call ratio peaked at 1.46 yesterday. It seems like everyone is expecting the latest bear market rally to head toward new lows. If we get another soft CPI next week, would you agree the market could see a huge short squeeze higher? Yes, but I just wouldn't call it a short squeeze, because while the put to call ratio is high, most people aren't expressing bearishness via options. They're expressing bearishness via gigantic cash positions. So the put to call is what gets that kind of thing going. That's that futures up 400 Dow points, that gap up. That comes from the short sellers being like, okay, we could take the hedges off, we don't need them, or we got to cover this. But what really leads to like the big rally then is the chase. It's professional managers who are extremely offsides, way too bearish, way too cautious, and then retail will pile on toward the end. So to me, absolutely, if you ask me, what's the trigger? Like, how do we get like a massive year-end run? It's exactly that. It's a better than expected, weaker than expected CPI Tuesday. Fed does 50 basis points the next day. Retail sales are just whatever the day after that. I don't see anything stopping the market if that's what happens. I'm not saying it will happen. I'm just saying that put to call ratio is notable. That is a century high. That is a century high of bearishness.
I guess moving back to, it's interesting to hear that take. The next chart I wanted to show was just talking about this year kind of in two halves, right? The first half of the year was just kind of all pain. That's the purple on the chart here. The second half of the year has been relatively, very volatile, but relatively flat. That downtrend was still obvious when we looked at the full year in the chart, but when you're thinking about earnings, when you're thinking about other things you're keeping an eye on, those are.
Wait, I don't understand I'm sorry. This is the first half versus the full year?
This is the first half of the year versus the second half of the year. So,
okay. So the first half is purple.
Yeah. And the second half. So from July 1st or June 30th. Till
so you're saying like the fall correction wasn't as severe as the summer correction.
Exactly. There's just been maybe a little less pain in the second half of the year.
I don't know. There's nothing there.
Nothing there.
No. Throw that out. Next.
Sorry. Well, no, I guess I just wanted to kind of tee this up. You've been talking about things you're keeping an eye on for next week, but I think this is maybe where Connor was going. But, what are some of the other bigger trends that, we might want to touch on here in the last few minutes that are going to be top of your mind for first quarter next year, just indicators you might be looking at?
So the VIX and the dollar were the two most important things to keep an eye on this year. And I've been talking about this all year. I have never seen the market so perfectly uncorrelated with the dollar in 20-something years of doing this. If you guys do the VIX up, we could do that if you want. If you followed nothing else, the dollar versus the basket, which is yen and euro mostly, versus the S&P 500, it was like a mirror image the entire year. And the dollar printed a lower high in the September-October period, and I can't declare the uptrend officially dead, but it kind of looks that way. And that's been interesting for a lot of assets, but most notably developed international stocks, EFA, the S&P itself, gold and silver. The dollar rolling over, I think, and breaking that uptrend is one of the most meaningful reinforcements of the recent rally in stocks. It's like the thing that is like the confirmation, right? It's hard to believe in a stock rally if the dollar is still going nuts to the upside, and that's over. Let's talk about the VIX. Give me just an absolute VIX chart in original terms. All right, so pay very close attention to this range. I spoke to Nick Colas, I think early this year, maybe January, February period, when the volatility really kicked into gear for the S&P. And he was saying, if you just think about the VIX as a floor and a ceiling, start thinking about anytime it's approaching 20, find something in your portfolio to sell, because things have gotten too chill and something is going to come about that reintroduces that volatility all over again. And vice versa, above 30, think about what a VIX above 30 is pricing in. It's pricing in a massive event. And most of the time that doesn't happen. So above 30 is where you have to find something to buy. I don't care how bearish you are. Even if it's Russell 2000 index, IWM, whatever, just put something on VIX above 30, because worst case scenarios are rare. If you had just followed that strategy this year, you didn't need anything else. You didn't need the dollar. You didn't need moving averages, earnings, interest rate, nothing. That strategy worked beautifully in terms of timing the market, which I don't advocate, and that's not what we do. But I'm just pointing out, there are times when it's just that simple. We're going to have a range. Things will get way too negative. Use the VIX as your gauge. Throw out all the AAII stuff, which has been in extreme readings all year, hasn't helped at all. Just go by what people are actually doing, not what they're telling polls. And when they get crazy negative, find some reason to buy something. And vice versa. when they think the coast is clear and you're at a 19 or 20 VIX, take a profit in something. And if you had done that, you had an okay year.
Yeah. Holds up.
Won't always work, but that's like one of those things that worked really well in this environment.
Connor, what else do we need to hit? We're running short on time. I know.
Yeah, we've gotten a couple questions about active versus passive, as well as value versus growth. So maybe we just take 2 minutes to take a peek at one of those charts, and definitely tied into the interest rate picture, but also we've talked a lot about that active. This should have been or could have been a year for active managers. Any thoughts on active and passive, Josh, heading into the new year?
Well, there are some active managers that did great this year. And
I think we're going to see that on this chart as well.
Yeah, I mean, if you're active value fund and you pick the right industries, you did great. But how does that help you after? So is that going to happen again next year? This is the thing about the active passive. I can't spend 10 minutes on this again. This is the thing people don't understand. It's not that there aren't people who beat the market. It's that it's not the same people every year. Listen to me. It's impossible, because if somebody can do that every year, then a lot of other people are going to copy that person, which is going to wear down the returns. It's mathematically impossible. Additionally, the market's character changes. So if you specialized in growth investing, you looked way smarter than you actually were in 17, 18, 19, 20. You're not that smart. Your strategy was in favor. And then you have to go 5 years where you're not in favor. And can you keep that money under management? So like, if somebody is investing for more than 3 or 4 years and they still don't understand this, I don't know what to tell you. Like at this point, like it's not a theory. We have numbers that we have the SPIVA scorecard from S&P Dow Jones. They have no vested interest in telling you that outperformance doesn't persist. They hate that. They're selling data and publishing newspapers based on the premise that it does persist. So they're not trying to upset you. It doesn't persist. There is no rhyme or reason for who is in the bottom quartile and who's in the top quartile. And after 5 years, nobody who was in the top quartile is still there. Nobody. And even if they were, how would you be able to identify them in advance? Oh, he has an MBA. Oh, does he? Like seriously, it's enough. So in any given year, there will be strategies that are in favor. David Einhorn crushed it last year. He was short all of the bullshit. He was long all of the good shit, and he had an amazing year. He's brilliant. But in his last letter, he said it himself, I'm still nowhere near gaining back everything that we trailed the benchmark by back to whatever year, 2016 or something, because that's how hard it is. And you're not smarter than David Einhorn. So like pick the games that you want to play that are winnable is my takeaway here.
Wow. That's a great takeaway. Caleb, anything to add as a final takeaway here?
Well, I think this scatter plot supports that sentiment too, because what we have here on the y-axis are flows, returns on the x-axis, and you can see, I mean, you just get people chasing returns often in these actively managed funds where fund manager lags, they eat that performance and then they sell out of it and move into something that has been outperforming. Which
the next it's the hot dot. We call this chasing the hot dot. I'm glad you did this as a scatter plot. When do you think Kathy's best 6 months of inflows were?
Easily
when they were.
Yeah.
June 2020.
What if I told you that on a net basis she's lost more money than she's made people? Because she had almost no money in her funds during their best period of performance. She had a ton of money in her funds during their worst period. So on a net basis, while she had some great years, she net lost lost money for investors. Even she had 6 ETFs that more than doubled in 1 year. That's like a Michael Jordan year. Like nobody has ever been able to do that. It's amazing. It's just, it wasn't sustainable. It was very specific to a time and place and an environment that favored a strategy and a few quirky things like Tesla being a once in a lifetime stock. Like a lot of things went right. If your reaction to that was to extrapolate that as I'm going to put 10% of my portfolio into that fund because that just happened last year, like you don't know anything about investing. No offense. You don't know anything. You need to start reading books and not read tweets and watch TikToks. So like it's not an anti-active management. It's just like understanding what is reasonable in terms of expectations. We love active managers. Like it's, just like it's more about what do you think is going to happen versus what is reasonable. And if you have reasonable expectations and there are managers whose version of a strategy you believe in, you should invest with them, but like soberly.
And not because it's, to your point earlier, the social media was just fuel on that fire with, one name or a couple names.
And what's funny? Everybody learned a lesson, and in 5 years we'll do it again. It'll be, it's the nature of what it is to be human. Yeah. And I am every bit as susceptible to this stuff as everyone else. So I don't sit in judgment. It's just, this is what it is.
Yeah. Well, thank you. I know that we're just after 12. Josh, this was an awesome time. Thank you for the words of wisdom. And Caleb, if you could hit next slide right here. Anyone who's on the call, if you're not using YCharts already, just mention Josh Brown and we'd be happy to hook you up with some advantageous pricing.
Oh, that's cool. Josh, I didn't know you guys were going to do that. Very nice.
Oh, yeah. In addition to the idon'tshop.com swag giveaway, but
Tanya will tell us Tanya will tell us who had the best comment or whatever, and we'll send something out.
You did get some 90s JTT comments.
I know.
What color do you use? Yeah.
I know. I couldn't read them all in real time. I'm sure they were great.
All right.
Thank you guys for watching. I appreciate you all.
Thanks, everyone.
Bye, everybody.
Thank you, Josh. Thanks, Connor. Thanks, everybody.